Let's move forward. Real estate investing, the changing rules of the game. The landscape of real estate investments is undergoing profound changes, driven by confluence and economic, technological, and societal shifts, traditional paradigm, and giving away to a more dynamic and adaptive approach as investors navigate the evolving demands of the market. Technology such as prop tech innovations is reshaping how properties are managed, valued, and transacted, enhancing efficiency and transparency. Moreover, the impact of global events, including the COVID-19 pandemic, has accelerated trends such as remote work, influencing preferences for residential and commercial spaces. Sustainable and ESG, environmental, social, governance considerations are increasingly influencing investment decisions, reflecting a growing awareness of the long-term impact of real estate on communities and in the environment. As the industry continues to embrace change, real estate investments are becoming more resilient and aligned with broader socio-economic and environmental goals. For the next panel, I would love to call on stage Balaji Rao, Managing Partner, Axis AMC. A round of applause for Mr. Balaji. Rahul Rai, Head Real Estate Investment Business, ICICI Prudential Asset Management. Nishchal Joshipura, Head Private Equity and M&A, Nishith Desai Associates. Sahil Shah, Director, Certus Capital, Earnest.me. Yeah, you may please begin.
So welcome to all the panelists and the audience. This panel is very unique for me because this is the first time in 22 years that I'm on a panel where all 4 panelists are chartered accountants. It has never happened earlier, so quite interesting for me. And because all of us are chartered accountants, there will be a lot of numbers that will be thrown at you. So be attentive and to absorb all the numbers. But before I ask questions to the panelists, quick summary on the numbers for real estate in 2023. The overall private equity investments in real estate declined from $5.3 billion in 2022 to $3 billion in 2023. This is as per the Knight Frank report for 2023. As far as the asset classes were concerned, office, commercial, and retail got maximum investment, 58%, followed by warehousing about 23%, followed by residential, 19%. As far as geographies are concerned, Mumbai got the highest investment, about 55%, followed by Delhi about 28%, followed by Bangalore about 15%. And we are sure that in 2024, Mumbai, Bangalore, and Delhi are going to get a very tough competition from Ayodhya and Lakshadweep, given that they have engaged the smartest marketing person in India. So that's going to be an interesting thing. We already seen a lot of investment opportunities that have opened up both in Ayodhya and Lakshadweep. And I'm sure all of you must be getting those WhatsApp messages and flyers from different developers. So I think with this, let me just move on to the panelists. And my first question is to Balaji. So Balaji, we have 2 major elections coming up this year, one in India and the second one in the US. Do you see the capital raising environment getting impacted on account of these 2 elections, and whether the real estate sector will be bearing any brunt of it?
If you're asking whether there's a correlation between politics and real estate, there would be, because politics and the economy is related. And when you think of these are 2 major elections, plus there are other elections round in the neighboring countries also. So the geopolitics, will it affect real estate? Yes, in a way it will. At the same time, if it runs the course as we expect it to run, especially in India, then I don't think there will be too much of a wave effect. It will just be a ripple. So when you look at the broader aspects of geopolitics, today we are, to quote Charles Dickens, we are in the worst of times and we're in the best of times. Because globally, things are not so great as we find it in India. So we are an outlier. And does that augur well for India? In a way it does. And can we also catch the flu? Yes, we can, literally and metaphorically. So I think we have to be very cautious this year to see that based on how the results are panning out as to how we play the game. The good thing about real estate per se is that I think we are on the cusp of a huge uptick in this industry. I believe, like in China, which took place maybe about 30 years back, this real estate will be one of the engines of growth for the entire Indian economy, given its relative association with 250 plus industries and is mostly domestic oriented. So this is going to really pull the economy. So there will be a lot of focus in this market, whether it's from the equity side or the debt side or the demand side. And so whether the politics itself will derail it, I don't think so. It can create a few road bumps, but overall, I'm very positive that in this coming decade, we are going to see a huge, huge growth opportunity in this sector.
Sure. And between China and India, at least what we have been hearing is from a lot of large global LPs, is that China is paused for the time being, and they want to kind of allocate more capital to India. Is that something that you are also hearing?
Yes, absolutely, because the China Plus strategy will always work in favor of India, and more foreigners are looking at it. Yes, some of them had got bitter experiences when they first entered, but people have realized that has just been an aberration, because the growth story and the fundamentals is very, very strong. And what we see of real estate today is not the same real estate as I saw 15 years back or even 30 years back. There's been a huge change in the industry. And this is auguring well for our future. So I would think that we would start becoming a very viable alternative to China.
Rahul, the REIT and the InvIT regulations were introduced in India in 2014. But if we look at the tally in the last 10 years, we have about 22 InvITs that have been launched. But as far as REITs are concerned, only 4 REITs have been launched. Do you see any reason for that on why the REITs have not kept pace with the InvITs? And second question would be, what would you want to see as a major change for more REITs to be launched going forward?
Sure, thanks. I don't think there is a specific reason why, InvITs we find a lot more number than the REITs. One of the angles to look at it is many of the InvITs that we speak about in this 22 are private REITs. I think listed REITs are 4 to 5 and compared to 4 of REIT kind of a thing. I think there is also another softer angle to it, is that some of the infrastructure projects are a lot more clearer in their cash flows, because they are annuity projects or they are predefined kind of a cash flow project. And also quite a lot of them do have a better institutional backing than in case of REIT, which are led by private developers. I think these are some of the reasons, but what I understand is compared to earlier years, last year substantial investment has gone into both the categories, InvIT and REIT. I'm not saying that, okay, one will do much better than the others. They have their own investment theories. But I think we are finding more and more traction, more and more appealing of this class of investment opportunity to the investors. And I think going forward, for more REIT to come, I think it's partly to do with the structuring and the internal restructuring that many of the developers have to do within their own ownership structure before they come out to REIT. That's one thing. The second thing about REIT is, so far what we have seen is 3 office REITs and 1 retail REITs. Maybe we need to see more of other categories of REIT also, like you have internationally, maybe hospitality or multifamily residential housing. So yeah, there is a lot more scope of expanding the REITs and should happen over next 4-5 years, I would say.
Sahil, as far as private credit is concerned, do you see that wave continuing in 2024?
Yes, the short answer is yes. I think the story is very similar to, in real estate, very similar to what we heard on the previous panel on private credit in general. The banks and NBFCs have been almost retreating for various reasons, whether it's RBI regulations, whether it's their balance sheet issues that they went through post 2018. At the same time, the underlying sector has done very well over the last 2 years. I mean, 2023 we are talking of as best year in decades as far as residential is concerned. So it presents a very good vintage and an opportunity to to invest into private credit in real estate projects. It is a specialized asset class, so you need to back the specialized managers, asset managers. But it is, to our mind, it is an excellent opportunity, today, as capital continues to be less available, and the sector is doing fine, and it needs a lot of capital. So to answer your question, yes, we see a lot of private credit in real estate.
So interestingly, on the enforcement side also, we have been seeing some action. In fact, last year we actually enforced one share pledge in a real estate deal where we, for one of the investor clients, we took over the project from the developer. So to that extent, now there are more and more precedents also that are coming up in the market where, some of these enforcements are happening. Because the first question which anybody would ask is, we are putting in this much money, but what if things go wrong? Will we be able to recover our money back? And, initially, a decade back, the answer was, pray to God. At least now we have IBC, Rare Eyes there, and some of the enforcements are also happening. So to that extent, the scenario is improving a lot more. Obviously, a lot more can also happen, but at least it is much better than where we were a decade back. So let me ask one more question on, given that all of you have more than 2 to 3 decades of experience in real estate investing, Balaji, to start with you, what are the major learnings that you have gathered in the last 3 decades of your investment experience?
See, over my career, what I have seen is real estate industry, when I first started, was like a mom and pop industry. As it becomes more corporatized, institutionalized, professionalized, it starts gaining its own credibility. And when it gains credibility, it attracts domestic capital, global capital, not just from the known family and associates, but also from larger family officers, ultra high net worth individuals. And that's very critical for this industry. Not having a regulator was a big setback for this industry. As we all know, the stock markets really grew after SEBI came in the early 90s. Till that time, it was bucket shops and all sorts of frauds were there. So similarly, I think the emergence of RERA 5 years back has changed the landscape for this industry in quite a way. Whether it's a deterrent or whether it has penalized builders, it has helped. And I think we should strengthen RERAs all over much more, because we need to get this industry from the shadows into the main stage if it wants to become one of the engines of growth. People should have some sort of a trust that irrespective of who is the developer, there is a lot of regulation and control and governance out there. And that, I think, has been the big learning, that if you don't have that, then there is a setback. Just like we were discussing REITs, as he rightly pointed out, Rahul, that unless you have institutional backing and all that, it's not easy to go to the next stage of REITs also. Because if you don't have an institution backing, how will a private sort of an investor come in, an individual investor? So I think most of the big developers have understood it, and they're playing the game much better. But I think the larger one is still like an iceberg. As you know, this industry, 90% is under the water, and it can sink anyone. So I think that has to emerge out of that sea and be seen as transparent and credible. And that would be the big change, I would say.
Sure. Rahul?
Interesting. As you say, I mean, over 2 decades of experience. So what are the learnings? But I have to say one or two of them. I would say that time is of essence. We say that. But in real estate, it becomes very critical. Because if you don't perform on time, then there is a cost involved of both loss of equity, the interest burden, and so on. And I think linked to that, other interesting thing that you will find is that bigger is not necessarily better. If you have a large township which takes 10 years to develop, it will come across cycles, it will come across challenges, and so on. So sometimes it's better to have a small or a medium scale. Keep your focus more on the medium scale kind of projects rather than, going into larger scale. Because larger scale come with their own challenges. So from an investment point of view, that's a very critical lesson that one has learned.
Sahil?
Yeah, I think to me it comes down to real estate is a very cyclical sector, and then the capital markets or the funding side has its own cycles in terms of availability of funds, etc. So it's important to have the right vintage when you are investing, and like any other investing. I mean, this is not specific to real estate. If everybody is chasing something, you have to be cautious for that sector. That's my learning.
Sure. So at least as a lawyer, I had couple of learnings from advising clients. I think one is, the due diligence that you conduct on the project. And, in my initial years of my career, there was a very interesting deal for one of the large domestic GPs that we were doing. It was a property in Delhi. And the project, the development rights were sitting in one entity, which was an SPV. And that entity had got the development rights transferred from one of the parent entities. And this had happened in about 1995. Now at that time, there was a stamp duty of certain percentage that was supposed to be paid, which was not paid when the parent transferred those development rights to the SPV. And our client at that time, I think this was about 2008 or 9, when they were investing some 125 crore in the project, in this SPV to develop the project. Now, when we did the diligence, we found out that, this stamp duty was not paid, which is kind of very important for the document to be enforceable. And when we actually calculated the stamp duty from 95 to 2008, together with penalties and everything, the amount was coming to 150 crore. Which was much more than the investment amount for, that our client was putting in. So actually the client had to back out of the deal because there was no other solution in this case that was possible at that time. And anyways, those were the heydays of real estate where, there was lot of deals anyways that were available in the market. So the client decided to not do the deal. So that was one interesting experience. The other thing that we have been seeing, and this is not just common to real estate, but to all sectors, is the role of the nominee director of the fund on the board of the SPV or the project company. And here we have seen a lot of issues, especially during 2012 to 2015, when maximum disputes had happened on put option by the fund on the developer. And what we found out is, there is no clear understanding amongst the director nominees about their role as a director versus their role as a shareholder. So there have been a lot of WhatsApp messages that were found where the director just extended the put option timeline without asking the shareholder. And the directors used to kind of, do certain things which only a shareholder can do under the shareholders agreement. And that actually became a big issue when the dispute started, because some of these WhatsApp messages came out that, you guys had only extended this. Where is the question of honoring the put option, and then we had to kind of segregate the role of director from the shareholder, and a lot of those things happened. But I think this is another thing which, again, we tell all our PE clients that, you need to clearly understand that there is a significant difference between the role of a director who is supposed to protect the interest of the company versus the role of a shareholder who is supposed to take interest of the shareholder in mind. So I think these were kind of two interesting learnings, from advising clients on investing in real estate sector. But let me just ask another question on, while we have seen commercial properties being quite hot in 2023, and I think that's where most of the pension and sovereign wealth funds are interested. Do you see the same trend continuing in 2024, where some of these assets will continue to get more investments?
Oh yes, because I think why we have been an outlier and why we are so buoyant even in the commercial sector, as Sahil rightly pointed out, it was one of the best years we had in 23, where the net absorption bounced back to the pre-COVID times. And finally, even during COVID, we still had a positive net absorption. That means people were still absorbing office space at half the rate, but still it was there. So we generally do about 40 million square feet of net absorption. During COVID, we did 20. The reason behind this has been the phenomenon of just the GCCs. And that has been completely transforming the Indian commercial real estate landscape. Because I almost believe 50% of the demand comes from them. And that is growing at a faster pace because as you have more margin pressure abroad and more of the talent is out here, I think we have come a long way from the BPO and call center times to what is much more value-added services being put into the sector. So they require a lot of space and they require much better quality spaces also. From the ESG side, from the health side, it's not like what we used to have, like the real bullpens out earlier when we did the BPO call centers with almost 60, 70 square feet per person. Today, it's almost doubling of that. So the requirement for commercial real estate is growing strong. It is there in the tier 1 cities, definitely for sure. But it might also creep into tier 2 cities if we find that the talent is also there or they are willing to relocate or be stationed in their hometowns rather than come to the major metros. So I would assume this trend will continue for a few more years and it's unlikely it will fall off. And one interesting statistic I'll tell you, the whole of Indian commercial real estate is around 650 million square feet. And the commercial real estate space in Manhattan district is around the same. So if we really think that we have to be a large global power, we are way ahead, and I think there's a lot of opportunity out here when you think in those numbers.
But do you see, I was just thinking that compared to the large investors we have for InvITs, we don't have as many global investors who are interested in real estate. Like you can count 3, Blackstone, Brookfield and GIC, right? These are the 3 largest investors who can cut big checks. Where do you see more capital coming from internationally? Like domestic pool, we are seeing that increase happening already, but obviously, the check size will be much larger from global investors. So is there any new entrant that you see in Indian space?
I'm sure there will be, and I'm quite clear it will come from the East Asia. You'll see from the Japan and all that, the money will flow in bigger, this thing. You'll see it from Korea, you'll see it from Australia. Because I believe, truthfully, that people who have deeper pockets and longer term vision will do much better. The initial flurry which we saw in 2006 were people thinking that these are low-hanging fruit, let's just go and grab some good opportunities and go. That's not available in India. In a way, we are far more developed. And I think, as the joke went around at that time, you had the money, I had the experience, and after the whole cycle is over, you have the experience, I have your money. So that was the joke. But in truth, that's what actually happened. So anybody who has a longer-term vision will benefit, like all these guys have. So I think that will attract more and more larger institutional players, sovereign wealth funds to come in. Some of them are already playing in a big way, if you look at the Middle East funds and everything. So I think the trend will be stronger and stronger, definitely.
Rahul?
I think I echo the views. It's a similar view. Office continues to remain a long-term investment opportunities as opposed to, let's say, residential and so on, which are for sale kind of a thing. So I think, yes, the office phenomena or majority of the investments going into office, especially the foreign investment which comes, will continue to remain so over quite a lot of number of years. And if you see the Indian office sector, the way it was able to withstand during COVID times and even now, where internationally it's severely financially challenged, where the Indian office sector is doing pretty well. So I think it's a much better positioned investment opportunity and continues to do well. And I think over a period of time, as more and more REIT emerges, as more and more people clean up their structure and become REITable or become into REIT, because now I think even private REITs will start happening. You'll have institutional investors and developers just creating a private REIT kind of a thing, and there will be a listing also. So I still believe, yes, office will continue to remain the primary target of all these investments.
Sahil, you have any thoughts?
Yeah, I mean, in the long term, as large in long-term holders of assets, they will always gravitate towards towards large offices and retail. I think what you're seeing a slower trend over the last 12 months or even in the near future is more driven by what is happening outside, where there is fair bit of stress in most Western markets in the office sector, whether it's likes of New York, etc. So and almost all of these large players have larger bets there. So some of that, unfortunately, that negativity bias just does flow into the decision making. So yeah, they might be slow, but in the long term, yes, Indian office is something that most people should be allocating to.
Sure.
See, the other interesting thing about office versus other sector has been the pricing part of it. When the sector opened up, office was the costliest compared to residential and other thing. But today when you see, you will find residential prices to be a lot higher. Office continue to have that dollar rental kind of a thing, and that puts a particular level of the capital value. So there is a ceiling on the capital value, which helps people to predict it much better. And that's why it continues to remain, again, a preferred sector.
So one last question. Are there any new models that are coming up for development or for investing? Like, we are hearing a lot about fractional ownership model. At the same time, on the investment side, crowdsourcing is also being talked about. Do you have any thoughts on that, whether in India or are there any other models internationally that can be replicated in India to deepen the real estate investing market?
Yeah, that's interesting. What we really require in India is to widen the scope of investment from the bigger family offices or UHNIs to the actual individual also who can participate. That's what REITs did, and it helped. So to that extent, that's why you suddenly see this whole fractional ownership, which is coming up in a big way, because people do want to participate in this asset class as an investment, but they don't know how. So this also indicates that real estate is moving from buying a physical asset, as we used to do maybe 15 years back, to somebody buying a paper asset with an underlying real estate asset. So this is a big sort of a step which will happen. Yes. And the second thing in India which we really lack, and I think that's something which the government should take an initiative to develop much more, is the secondary market. You need a secondary market for everything. Whether it's an AIF unit or whether it's a non-unlisted bond, you should need a secondary market and a market maker who will find a price for it. Because when you do that, then there'll be a wider participation. Otherwise, it suffers from the shadow of illiquidity. Everybody, as Sahil rightly said, it's a cyclical industry. So as soon as it's in the downturn, everybody says, oh my God, I'm stuck. who knows when the next boom will come. So there should be a price for everything. And if you look at the US, greatness in this finance market is because of that. There's a price for everything. You can get out anytime you want, as long as you're willing to take that hit or the cut. So I think that secondary market will need to develop, especially when we want to do so many things in real estate, whether it's data centers, warehousing, you will have this senior living, student housing. So there are a lot of asset classes which are fast coming up. So this will require a lot of capital, because everything cannot be run on just sales, because the sales model will not be there, especially when you see the new Gen Z. They don't want to buy houses. They just want to rent it and experience it. So you will still need the landlord class. So when you need that sort of a capital, you do require to widen and deepen this entire sector.
Any of you want to?
No, I think more or less the same. Maybe further deepening and expansion of the corporate bond market, so that people can borrow well rather than just relying on friends and family or equity dilution, will really help people to execute the projects. So.
In fact, there was a very good paper from RBI on secondary bonds, which unfortunately hasn't been converted into law, but it provided very good suggestions, like FPIs can directly buy the loans from banks rather than going through the ERC structure or going through any trust structure. But somehow it didn't go through. So I think one of the other things for some of these new structures or business models to work is to also customize the laws in a manner where it becomes easy to structure some of these things. Now today, if you look at some of the things, like the first question somebody will ask is, I want 5 investors who want to invest in a project. Now if I set up a company, anybody, any investor with more than 2, SEBI can come back and say, it's an AIF, right? Because it's a pooling vehicle. Have you registered? So some of the basic things. Similarly for fractional ownership, you will hold a project in an SPV, and SPV will issue, debentures to all the investors as a tracking stock for their particular share of fractional ownership. But then if it crosses certain number, which earlier for Sahara it was 50, but now it is 200, you again get into some of those other issues from SEBI. So I think there are interesting business models, but the regulatory structures don't allow some of these things easily. I mean, we will always find a way out to do some of these things, but it's not something that is very straightforward and simple.
Yeah, I mean this trend towards financialization of physical assets or real estate has been a global trend. You will see a lot of people innovating and coming up with that option, that product for for smaller ticket size investors to also invest. You rightly pointed out that there is now some of this is new for the regulator also. So there may not always be a regulatory framework that fits, and you need to find solutions around it. But at least in a lot of instances, the regulator has recognized some of this. I mean the MSME REITs, the framework that is there. I mean it is interesting. I mean they an interesting way to set up some of these co-ownership or fractional models. Now there are these OBPP platform regulations which can help develop capital markets for the sector, which is really lacking today. As a developer, your financing options are quite limited. There's no reason why there should not be a capital market for the sector. So yeah, it's evolving. Is what I think we are seeing.
So maybe I think we can take some questions from the audience. Anybody has any questions? Yeah, please.
Requirements that are coming up, right? MSM REIT is one of them. But you believe that MSM REIT may not take off as compared to the earlier REIT, the InvIT and REIT conversation that you were having. If you can kind of detail out why MSM REIT cannot take off as everybody in the industry is envisaging.
A smaller REIT on the being done on the private side as opposed to being listed. So, sorry, I mean, if I may take that. So yes, as far as the MSME REIT regulation, they came up with a framework, and the industry went back and asked for a few changes. Some of them were accepted. I mean, I think it's a function of regulatory evolution. I mean, the concept in principle is something that is interesting. I mean, that will work, and again, it will work only once you can create a secondary market for those units. You know, and that you need to allow, you know, some firms or some investors to become, say, you know, market makers for that. Only then that really will pick up.
It also depends a lot upon the quality of the sponsor. As you go down the value chain, naturally the sponsors might not be tier one. So there will be a hesitation in the market to subscribe to them as readily as they would do for a larger REIT, which has been sponsored by the big names. And that has happened so far. So that's why maybe, but I think it will be overcome once they see it in actual motion and it playing out in the market, then I would think they would be accepted too.
Thank you.
Any more questions?
Hello. Hi, this is Ajay Arora here from Amanat Family Office. I just wanted to have your views that, you know, we are all talking about very positive. Then why would WeWork go underbelly?
One, I mean, I'll attempt. Why would WeWork go under? I think WeWork is a in the US, which went under. There's one fundamental, you know, this thing where their underlying leases are long term, and their clients are signing up to short term leases. So there is a mismatch in that. And second, what has happened there is there has been a massive erosion in or fall in rents within most markets in the US. So suddenly you have a situation where I'm locked into a very high value lease, but my clients which have committed only 6 months or 12 months to me can walk out and renegotiate down to a much lower market rental. So I think that's, I mean, it's a simplification of this thing, but I think that fundamentally is a problem. Now coming back to India, I think they're doing quite well. You know, we sit out of WeWork. We've seen the occupancy grow from 0 in 2021 or 2020 in our building to literally packed. You can't find a seat, right? So I think it's a function of again real estate cycles as opposed to, and that model has its challenges. But yeah.
I also have a different take on it. WeWork got valued as a technology company when it was actually a real estate company. And this might have been due to some of its investors like Sonsan and all of them putting the money in it. But you can't sustain such valuations on a brick and mortar model because this is far more simpler and transparent. Unlike technology, it can't suddenly wave a magic wand and become digital or multiply its profits. So that's one of the reasons why I think it got deflated too fast and it stumbled. And COVID, of course, I think drove the final nail into its coffin because they were depending too much on the short-term leases, as Sahil said.
And I think also the India part of the co-offices, I mean co-sharing, is doing very well. I mean, there are more and more players coming in and more such offices. And even good occupiers moving into co-sharing space rather than taking up their own office. So I think India, as usual, is different than the world model. It has its own model. And the co-sharing seems to be doing well in India as compared to outside.
They should restructure their operations and list in India.
They have, by the way, 45% of the revenue coming outside US. So they have understood the whole game, in fact, actually.
True. Okay. I think we can close the panel. So thanks to all the panelists for your valuable insights, and thanks for your patient hearing. Thank you.
Thank you.
Let's
Thanks,
give it a
everyone.
huge round of applause for all the panelists. Now I may call upon Mr. Udit Surekha to felicitate the panelists. Can we hear it for Mr. Udit Surekha? Can we have a group picture, please? Thank you. You all may please take your seats.